Welcome to the latest episode of High Stakes. I'm Paige Soya, managing partner of K Street Capital, and everybody knows this season is about exits. So today we have Sean Griffey from, well, multiple exits, but Industry Dive, now Informa, who's sort of seen this on both sides of the table as being part of a public company, buying other companies, but also as a founder, the whole journey of actually exiting sort of twice in two different ways. So we're going to dig in on that. And before we get started, Sean, do you want to maybe just quickly introduce yourself?
Thanks, Paige, and thanks for having me here. So, as Paige said, I'm Sean Griffey. I'm a co-founder and CEO of a DC-based company called Industry Dive. Industry Dive is a media information service company that publishes newsletters and research and insight for niche markets, including electric utility, healthcare, waste and recycling, biopharma, most industries, you name it. So we've been around since 2012, grew it from a bootstrap business, with just the three of us working out of, an office in Adams Morgan, to a little over 400 people, 100 million in revenue when we finally sold to Informa in 2022.
Awesome. So maybe talk a little bit about the difference between the first and the second exit, because you were basically entirely bootstrapped, right? You didn't take in any capital up until that first exit, when the private equity exit. So maybe just the background on that, the time period, and then the time period between then and when you ended up selling to Informa.
Sure. We did raise 400 in angels, so I got to take a little bit of,
a little bit,
but no institutional dollars, no VC rounds and the rest. But there were some local angel investors who, if they heard this, said like, hey, we were part of the story too. So give them credit for being a part of it.
Appreciate that.
Yeah. But, we did, by and large, bootstrap it relative to other folks. And we grew to just under 30 million in revenue with that 400,000 in a couple years. And at the time, we started getting a lot of interest from strategics and people in the marketplace, and certainly private equity looking to do acquisitions. And, we went down the path with a couple of them. And quite honestly, we knew that there was a lot of runway left in the business. And we were very picky about who we wanted to work with. And I actually thought that we didn't need to find any sort of partner. And I was in the process of trying to raise debt. And we thought we could finance this off of the cash flow, finance the next round of growth off of our own cash flow. And at the time, private equity started knocking, and very persistently started knocking on the door and calling and trying to reach out. And honestly, I spent most of my time ignoring them, because if you've got a business of a certain size, you realize that some of these brand name private equity companies call and you get excited, but what's really on the other line is a 24-year-old analyst whose job it is to fill out a spreadsheet of potential clients in the company. And it's not someone who knows you or is really interested in your business. But we got a call from someone who actually knew a lot about us, had a strong market thesis, had a contrarian view of what could happen in the marketplace. And we had a very much contrarian view. And they came to us and laid this out. And we finally took a call, laid out their vision. And I actually went and talked to my partners and said, have we been sharing any of these internal decks at a conference? Because they had slides that looked so much like how we viewed the market that I thought they were parroting back what we wanted to hear. Mm-hmm. And so at the end of the day, we decided to do a deal with them because they had such a shared vision for what we were trying to do. Our business was at a point where we knew we had explosive growth, ahead of us, and that there was more that we could do, and that we needed capital, we needed a partner that could help us do it. And so we decided not to do a formal process. We didn't shop the deal around. We didn't look for anyone else, in part because I was afraid to get, a deal that was marginally better with the wrong partner, right? One of my advisors said is like, well, what if you could get $5 million more out of the next deal, but it's the wrong person? Would you ultimately be happy with it? And we decided no, we ultimately would be happy with the right partner, even if it was going to cost us money. And at the end of the day, I think that was a right call, and it paid off in spades over time.
Well, you had a great business at that time that obviously other people were seeing the path and the explosive growth, and you're getting all these calls from private equity. Was it Alex Jutkovich that called you? Just out of curiosity?
He did.
It
It
was him.
was. It was
Yeah.
Alex.
Awesome.
Yeah.
He's great. He's one of our investors at K Street. But I think that's, I guess maybe can you, because this is an unusual thing. Like usually people go through a process or they talk to a lot of different firms or they end up just going with one. But then once they get into that relationship, it ends up not being what you expect. That wasn't the case at all with your exit with this private equity firm. So maybe if you can share, like when you were thinking about doing this with them, like how long did you spend getting to know them and what really made you feel so comfortable with them? I guess because they had the same vision, but were there any other things that really like triggered you knowing like this is the right, this is the right partnership?
Yeah, I think there's a couple of things, and one is the homework you do before you even get into these situations, right? And you can't wait for someone to call to be ready to have the conversation. We had a year earlier gotten our first professional audit so that we had the financials ready. We had sort of a deal room kind of in place ready for due diligence if we needed it, with here's what the financials are, here are the metrics going back 5 years of the business, right? We had all of that information and, a financial model going forward, the 3 to 5 year forward model there. I'd spent a lot of time talking with, investment bankers and other people in the markets to understand valuations and what were a fair deal before we went into this. And I already knew the partners we wanted to work with, right? So we already had the relationships with a lawyer that we knew would handle the deal for us. We had the accounting partners and the rest. And so when, Alex and Falfurrias Capital, who was our private equity partner, showed up, we had done a lot of the background, pieces that you really want to be ready for if you want to get a deal done and a deal done quickly. And so to answer your question of what it took, I mean, it really was culture and vision that was the most important thing. But there was tells that we looked for in there, which is, okay, when their LOI came over, how down the middle fair was it? And not just on the valuation, right? But on the terms and on the rest. Like it's easy to start, some of these people will start with a term, term sheets or LOIs that are so geared towards them, and then you kind of nickel your way back to fair. And what we saw was one that was fair to start with, and we, fair enough that we really didn't feel a need to negotiate huge portions of it, right? Like we negotiated what was important to us, but we didn't need to do the rest. And that just spoke to the culture of the people we were working with, right? Is that they wanted to be partners right from the start. They put a good offer in front of us with fair terms and had a great vision, and the culture aligned. And so we didn't spend months and months dancing with each other. The signals were there right away.
That's really unusual that you were sort of thinking ahead. And like, I never hear people say that. People are always like, oh, I didn't realize I was going to exit when I exited, and I didn't have audited financials, and I didn't have all my ducks in a row. So, good advice for people to hear that because you did that, it kind of set things up in a way that made this really easy.
There are times when you go through due diligence and people ask, there's incredibly smart people on the other side of the table, and they ask you really tough questions about your business. And sometimes you come out of there and say, I really do need to think about this differently. I do need to think about customer acquisition or churn or service differently, because they had really good ideas and really tough questions that I didn't feel like I could answer. But if you force yourself now to kind of pretend you're going through that process, what discipline would you want to put on your business so you can answer those questions? And some of this is being prepared for a sale, but some of this is just good operations, right? Like you should have those metrics, and you should have a forecast that actually helps you see what your business is going to do and the rest. And if you can't produce that today, then question how you're running your own business. And so that's what we kind of thought, is that this is preparation for a deal, but it's also really us putting ourselves under a microscope and saying, if we were looking at our business, what would we be unhappy about? Which threads would we be pulling from the sweater to see what unravels? And you can get a long way, day to day just doing that.
Yeah. And then maybe talk about post transaction, right? So you were able to take some chips off the table, but obviously we're still invested in, in the new picture of the company, the new path forward with this private equity firm. And what did that look like? Were there any things you were surprised about, weren't expecting, not necessarily bad, but just learning going through that acquisition?
Yeah, I think some of this really kind of, what you get with a private equity owner in some ways depends on who the private equity firm is, right? And part of that is choosing your partners. I think I was pleasantly surprised in some ways, but not because it's kind of what we were expecting, is how much freedom we retained and how much they looked to us to be the experts of our business and our industry, and how much control we did sell them a majority of the company, right? And retained a minority stake. And they absolutely could have, used 51% to make any decision, but they didn't. It was operated still that we were the ones making a decision. And if we didn't believe in a decision, it didn't matter what they were believing in. And so that was a surprise to me. I was expecting when you sell and give up control, you're truly giving up control and you're handing over someone. But with the right private equity partners, you really get a partner and you really can control your business.
Yeah, I love that. And then after that, maybe you can share a little bit about the second exit that happened a few years later.
Yeah. So the business, more than doubled over the 3-year time period that we had with Falfurrias. We did some acquisitions, but a tremendous amount of organic growth as well. And that was honestly one of the, going back to Falfurrias, one of the great things about them is that they were in a hurry. I was in a hurry to grow our business. They were in a hurry to grow our business, and they deployed things that allowed us to make big steps forward, both organically and through acquisitions. And so when we, more than doubled, it got to a point where, they are financial buyers and they have a return for their fund. And it was shaping up that this would be a very good deal for them and for us. And for the business, it felt like we were at the next step of growth and that there were resources we could apply that would help the business. And so we went to market in 2022 and did it entirely different, which is we interviewed, 4 or 5 investment bankers and picked one and ran a whole process and had 20 some people, submit bids and went through gating factors over months and the rest. And finally ended with Informa, who again has turned out to be an incredible owner and partner for Industry Dive.
And maybe very different exit process. Talk about how long that process took, selling to a public company, and what that looked like afterwards also, because now you're there, right? You're part of Informa now, and it's been, I don't know, a couple of years. So yeah.
Yeah, we sold right in 2022 when the economy started getting dodgy, right? And the timing was but it was definitely an interesting period.
What was the month?
What's that?
What was the month?
September.
September.
Yeah.
Right when it was getting dodgy. Yeah.
Yeah. But, Russia had invaded Ukraine and the European markets were getting softer, and, there were buyers, potential buyers over there. And we went through a process. It honestly took a lot, longer than I thought. I remember, I still see it now. The shaving cream I use says 90-day supply on it. And I remember opening a new bottle saying, when this is done, like when I'm done with this shaving cream, we're going to be done with this process. And I opened another one after that, and I was starting to get afraid that I was going to go to my third, And so I looked at that and just said, oh man, this is never going to end. It is, when you go through these process, and we had private equity buyers as part of it, we had strategics as part of it, and you're running 5 or 6 groups through it, the due diligence can just be suffocating, right? They all have their questions that they want answered and questions that they asked. And in this case, incredibly grateful for the investment bank that we chose and how good they were. And one of the things I tell people all the time is, if you're going to run an involved process, it's great to look at the investment banker partners who are going to be the face of the deal, but you really want to see the teams below them who do all the actual work.
Oh, yeah.
who,
Nobody realizes that.
yeah, who answer all of the questions and do the rest. And, in some of those firms, you're going to get a 23-year-old who just graduated college, albeit an Ivy League school with a finance degree, but they're still 23 with a Ivy League finance degree and zero experience. Or you can find the firm that's got someone who's been in that role for 10 years and's been there, done that. And man, that made all the difference for us, is to find the boutique firm that knew our industry, knew our business, but also had a team that had been around together a long time and could shepherd the process through.
Yeah, that was Bright Tower.
Yeah.
Yeah, that's just a little shout out to Bright Tower, because we've also worked with them, and they are an incredible team. Really.
They recommend them highly. Couldn't recommend them more.
A plus there. Okay, so now you've sold also to a public company, still part of the public company, and post that transaction, is there anything after the fact that you kind of wish you'd known or was surprising about becoming part of a public company, really? And then I know, yeah, go ahead.
No, I mean, listen, like, if you stop and think about it, we started with 3 people. And, that's an incredibly different environment than private equity owned with real dollars, which is incredibly different than being, 400 or 500 people and part of a 15,000 person company. And so I think it's, I think for some businesses and cultures, it's hard to adapt, to each of those stages. And we've been really fortunate with the team who's been flexible enough to survive the changes that come with that. And they're small, like how you log, like sign up for healthcare and how you log time and things, which, we never did before, but that's just part of, a public company is all of this stuff. They roll with the punches of that. And I think they get energized by the mission and get energized by the possibilities, that having more resources and shared resources from the rest of the company can do for us. But it's an adjustment, for sure.
Yeah. And how big were you when you guys got bought by Informa? And I guess like number of employees?
Yeah, like 400 or so employees. And we've added to it over time, and we've certainly hired a number of people, and we have publications. And one of the first things Informa did was say, launch 8 more, right away. And so there were, strains of, okay, they want to be aggressive too, but in entirely different ways than we've done before. And so just kind of flexing to that, it's always a challenge, but I think it's one of those things that keeps things interesting, right? When you have new challenges in front of you as opposed to the same ones.
Well, yeah, that's why I think it's really cool that you've sort of stuck around for a while and you're getting to do other interesting things. So, and now you're sort of on the other side of the table, potentially doing some M&A as an investor, as a public company, which I think is a whole different ballpark. And maybe you can share what that's like, or if you have takeaways from that. I know that's maybe relatively new, but would be interesting.
So there's good and bad for sure. The good is the ambition is you can be much more ambitious in who you target, right? Like, we can swallow a lot bigger deals than I ever could imagine before. And you can stop and say, well, why don't we go by the market leader? Why don't we go do a deal with them as opposed to, the smallest fish in there and hope to someday compete with them? And so that's really exciting. It's also really exciting that I personally don't have to do all the due diligence. Like, there's a whole team that's job it is to make sure, that the insurance and, the entity structures were set up correctly for your acquisition, and they read, all of the legal documents, and I don't have to do that, which is great. On the other hand, there are whole parts of the deal that I don't get to do. Like, I'm just not in the room for those conversations and the rest. And so you give up a little bit, at times. Like, I didn't have to work until 2 a.m. reading all the documents to be ready for the 7 a.m. meeting, except maybe I'm not in the 7 a.m. meeting anymore, and it's a whole other team. And so that's an adjustment. By and large, it's been pretty great though.
Yeah, that's interesting. And I guess if I don't know how many acquisitions you've done since you started, or if is this sort of a new role that you've taken on?
Yeah, Informa's done quite a few, and the group that I have done, and we're just now doing a big one that's going to impact us the most, but definitely the pace of acquisitions have slowed down. relative to when we were bought by private equity. Just the scale of them dwarfs anything that we've done previously.
Oh, I didn't realize. So you were also on that side of the table after the PE buyout
Yeah,
too.
we probably did 3 acquisitions, one really material one, but a number of tuck-ins as well.
Any gotchas there, or like wild cards that like you did the deal and then you're like, man, I should have asked that, or I wish I'd, known
No,
that.
I just think you have to be very clear why you're buying someone. And it's funny, with every private equity firm that I've worked with, in some ways, they start to look at the revenue and EBITDA and think that you're buying revenue and EBITDA, particularly with some of these smaller deals. We were doing some very small deals that we could fund out of cash flow, but we were only buying a couple $1 million in revenue. And they would ask about, well, is that revenue defensible and the rest? And I'd stop and say, like, actually, I don't care at all about the revenue. We're buying the audiences for the publication. Like, these are good audiences that we're buying. It has nothing to do with the revenue. And so I just see all the time people get excited about something, and then you stop and say, like, what exactly are you buying and why? And don't get excited by, well, look at how popular their, YouTube channel is and the rest. Like, that is great, but it may not be what you're actually buying. You're buying something else.
Yeah, and the more transparent you can be in the process of going through a deal, the better it ends up after the fact, right? I think it just,
Absolutely. Yeah, no, that's probably the best lesson of all.
yeah, yeah, exactly. Are there any other, I would say, like key takeaways or advice you would give to founders about to go through this, or investors who are going through exits?
No, I mean, I think we talked about it at all. The number one thing you can do is build a good business and run and be in control of your business, because then that just gives you so much flexibility and options, right? The worst thing you can do is feel like you have to do a deal, or that you've gotten so far down the path that the deal has to close and the rest. And you want to love your business enough that you can stay and hang on to it, and there's a vision there. And if you can't, then you got to really question, like, what's the value of what you're selling anyways, right? So, to me, it's like you want to go through these deals and be ready to walk away at any time if you need to, and be happy if you do.
And be able to, it allows you to control your destiny. And I was just talking to another founder today, actually, that is one of our portfolio companies. Great founder. He'd had a prior exit before this company, and his advice is always to, get at least a small exit, but get one relatively soon in your career so that you can have resources and experience in doing the second thing, which will be a lot bigger. And the second thing he's doing, he's got the company was growing super fast, now has leveled off, but still growing, at a decent clip. He doesn't want to raise money right now, obviously, for, the timing of the market and because of that and whatever, but because he sort of has, but he knows he's got the underlying unit economics of a good business. So he wants to keep going with it, but he's because he had that exit previously, he's just loaned the company money to get to cash flow break even and profitability this year, which they got to get through that storm, and then to go raise, later when they really feel like they're putting fuel on the fire and not
Position
diluting
of
them.
strength versus needing. Yeah, that's
Exactly.
amazing.
Yeah, it's just so smart. Obviously, you can't always control that, and not everyone has had a first exit. Well, your first exit's always your first exit, so you may not have those resources. But I think it is just great advice to really make sure you actually have a real business that's good. Like, that's the underlying most important thing that matters in all of this.
Absolutely. Absolutely.
Well, cool. Well, thank you so much for doing this.
A lot of fun. I'm just glad to do it. I've enjoyed the other ones that you've done in the past. So
Yeah.
it's a great series.
Yeah.